Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Charles Curry, Managing Director and Senior Portfolio Manager of U.S. Fixed Income at Xponance, to discuss what the credit markets are signaling. Charles, it's great to have you with us. Welcome to Trade Talks.
Thank you very much, Jill. Pleasure meeting you.
You got it. And banking is a confidence game. What happened with Silicon Valley Bank and Credit Suisse in terms of overlooking risk? And do you expect heightened regulation as a result of this?
A couple of things. As you pointed out, banking is a confidence game. And when I look at what happened at Silicon Bank, it was very much a niche bank that basically worked with a very narrow ecosystem of sort of private equity, venture capital, Silicon Valley players, if you will. And what happened is it's not so much as bad management per se, but just a matter of the function of the timing of the way things happened there. And I'll say this, is that if you think about banking, a lot of their deposits were uninsured and they were subject to runs. And I think once the word got out, the stock price had been plummeting over the past year plus or so. A lot of that very narrow ecosystem was very savvy in terms of digital assets and move their deposit. And without deposits, you have a serious problem with a bank. I think on top of that, given the fact that we've come off a period of extremely low interest rates, things that started to sort of turn in the past year. So we saw a dramatic rise in rates. Their portfolio, which quite frankly was matched against those deposits are a liability, plummeted just due to the fact that interest rates went up. And it wasn't the fact that they were invested in risky securities; they were treasuries and mortgage backed, which is what most banks do. However, when you've got a dramatic rise in rates due to the Fed rising rates, 450, 475 basis points, it caused a mark-to-market loss, and that's what caused a loss in confidence and made the depositors basically flee, if you will.
How do you think this impacts Fed policy?
Well, actually, a couple of things. Is once you call into question the confidence in the financial system, I think what the Fed did, and I think Jerome Powell mentioned it the other day, is that they did step in with liquidity behind that, and they saved that situation, and they're working on the other banks that could be subject to the same thing. That is a lot more uninsured deposits versus insured deposits. The ability to have a mark-to-market portfolio that perhaps has taken a big hit, so their capital buffer is not as good as it once was. What I think it does, however, is because of this concern about liquidity and what have you, is it's going to cause more of a credit contraction across all banks. So what you're having here is a debate, and I would contend that it actually serves to be probably a 25, 50, maybe 75, act as a 75 basis point rise in rates from where the Fed has taken it as of this past Tuesday. So I think if you looked at today, I think Bullard, who's one of the Fed governors, mentioned the terminal rate somewhere around 5 and 5/8. Which is, again, that's a pretty significantly different than it was, say, last week. But, that being said, I'll say that there was a real contention between financial stability and inflation. And I think Powell all but said that this situation has been handled and that we will back to looking at inflation. But as I said, between the credit creation, it's going to slow down dramatically because we're concerned about that and the impact on the economy. That's like a tightening in its own right.
Right. The MOVE index is the highest since 2008, and the market is extremely sensitive to all these influencing factors in the rates market. Explain to the audience what the MOVE index is and what it implies in this context.
Well, basically, the MOVE index is a coincident indicator, and what you're basically trying to do is short-dated 1-month volatility or options on different spots along the yield curve of the treasury curve, if you will. And because it effectively measures kind of a price of uncertainty, and the reason that it's as high as it is or it's moved this so much is the past 10 years or so, the MOVE index, very little volatility because rates were basically low. They stayed low. Not much happened. If you look on a long-term chart, the last time you see big spikes, the global financial crisis. You saw a big spike last week because of another banking crisis. So what is attempting to sort of handicap, if you will, something is going to happen because MOVE typically picks up when you have a very steep yield curve because they're concerned about, okay, what's the Fed going to do next? Curve is abnormally steep, or in this case now, the curve is inverted. So the curve is inverted as it is. It's like, my God, something has to happen. And if you're an options player, you're trying to leverage the direction of the market and where treasuries are going. So we're thinking, my God, if we're this far along, we're inverted, that implies a recession. And then secondly, from that, when you have a recession, the yield curves, short rates at some point will come down based on the Federal Reserve actually easing, and the curve goes the other way. So that MOVE volatility, again, it's a price of uncertainty and just trying to pick up on the direction of rates from a very short-term perspective.
Right. It was quite remarkable just how short term it happened within a week. What are the credit markets signaling?
Well, it's interesting. Up to this point, and something, even the way that we've been positioned, we have been somewhat almost scratching our heads, is that credit, the risk premium around credit had been fairly decent even through last year. In our own portfolio, we were sort of lessening risk because we found a lot of things still relatively tight or rich. And even up to this point, you were saying some situations where things might have gotten sort of back towards a long-term average, but the credit markets really were not signaling what we thought should be happening, is that there is a recession coming down the road, so spreads across the board should be that much wider. But obviously, when you had, as soon as you had the financial stability, then you had things widen out dramatically. But in some cases, things that were sort of unimpacted by this sort of banking financial spreads, if you will, those went out some, but we still haven't reached levels that you would expect to see in credit. If you're going into a recession, you expect to see much steeper traditionally, or I'm saying much cheaper traditionally, given the fact that we're looking at an impending recession.
Right. So then what's your outlook for the business cycle? Because it seems to be, we'll be dealing with this a longer duration, but not quite as steep as it could be.
Well, I think when you think about the business cycle, it's like we've had this sort of prolonged approach. The curve has been inverted since last year. We've been talking about slowing the economy down, nipping inflation in the bud. Inflation's still running at 6%, 5.5% on a core CPI number. The Fed is still raising rates to offset that. The only way they can do that is by dampening demand, or some people would say crushing demand. But I mean, it's the bottom line. Are we in a recession yet when you've got unemployment running at 3.5% and there's still 2-3 jobs for every person in the country? So that's sort of a conundrum, if you will. So I think in our mindset, we do see this impact of the financial system, then this slowing of credit, dramatic slowing of credit, adding to where Fed funds are. So you get Fed funds up around 5 5/8, and perhaps at that point, maybe we tip towards that recession. But I think when that happens, how that changes the business cycle is at that point, I mean, I guess my equity counterparts would be immediately looking for when do we cut and when do we go back, everything is normal, equities take off. But I think there'll be a period of time before we can get rates back to somewhat of a normal level. And I say that the Fed funds, because if it's 5 5/8, inflation's running at 6, the goal is 2. There's no way you get to 2 anytime soon, but maybe you get to 2.5, or let's say 3, 3.5, 4, because we would contend there's a lot of structural elements of inflation that just aren't going to go away, and it could be sticky. So you could have a period where the Fed funds is where it is for a period of time, and that we just sort of stay in this sort of malaise, if you will, and the curve will begin to uninvert as we get towards that recession, and then we sort of move into that next phase, possibly early next year, where we actually see a cut, and then you see the curve continue its steepening and sort of go the other way. So,
Charles, to wrap up here, as a fixed income investor, how would you be positioned in this backdrop?
Essentially, we're probably going to be, well, we are looking at credit. We find that whenever there's a lot of volatility and there's a lot of fundamentally things that are happening, we're thinking about everything from the scenario of recession, slowdown, higher rate environment. What does that mean for credit? So, we're looking at different structures, whether it be in bank paper, for example. We're looking at maybe hybrid structures or structures that are down in the cap structure, because at the end of the day, banks are having problems, but that's when the time it is to invest from a bond perspective, because given the fact that you've got the government backstop, a lot of banks the top banks are SIFIs, are systemically important, too big to fail. We feel like there's value there because they've been beaten up, maybe unmercifully. I mean, we look at other things, things like energy, spaces like that, and credit that have gotten beaten up. A lot of it having to do with what's going on in Russia and Ukraine, and what's going on with the fact that things have slowed, so oil prices are coming down. But in credit, we're still more or less higher quality. High yield still hasn't gotten cheap enough yet for us, and we're really looking to stick our toe in there. But quite frankly, high yield has not really gotten as wide or as cheap as you would expect, given an impending recession. So we're positioned, we have an overweight in what we say the spread sectors, credit, if you will. But again, we're staying somewhat high quality, keeping our overweight, and also being relatively short because the curve is it's still inverted. So we like it, but we're going to like it more as soon as we push towards this inevitable recession.
All right, Charles, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Okay, great. Thank you very much.